Everyone says that you should diversify your investments, and they're dead right. But no one tells you when you've diversified too much because, yes, this is possible, and it has a really cool name, which is Diworsification. I know, it's a bit silly. But if you've ever bought, for example, an S&P 500 fund alongside an all-world fund, then you could have fallen into such a trap. Or if you've just bought multiple funds thinking that you're spreading your risk but you're not entirely sure, then this is the video for you. Hi, welcome back. My name is Zoe and this is my channel, Words on Wealth. As a former wealth manager, I like to break down key investing topics and headlines to make you a more confident investor. To make investing simple, but also a little bit of fun in there too. So for me, I think one of the main problems that arises is that all-world funds are flipping fantastic, but they are quite literally what they say, all-world. And what often I see that people don't realise is that they buy an all-world fund and then they buy the S&P 500, thinking that they've just added more funds to their overall portfolio, diversified a little bit further, which in some ways they have. But actually, what they've really done, if we were to knuckle down on it, is just added more of Nvidia, Apple, Microsoft, some of those really big names that we're becoming ever more familiar with, and some of us will becoming ever more aware of the idea that actually our portfolios are becoming more and more concentrated in some of these major holdings. So by the end of this video, you'll know when adding another fund actually improves diversification in your portfolio, when you're just buying the same companies twice, and the key concept that professional investors use, known as correlation, to help them decide and understand when it's become diversification. So kicking off with diversification as a concept, of course, many of us will be aware that is all about not putting your eggs in just the one basket. Rather, it's about having multiple different ETFs, stocks, areas, geographical regions, assets, and so on to be able to manage risk within your portfolio. It's one of the first things that most investors get taught, and that is fantastic because it really helps people to firstly avoid losing potentially loads of money in just the one single asset or investment, but secondly also helps them to manage risk and keep things a little bit steadier in tougher times. But what I think most financial education misses is then when this goes too far, or how to avoid layering on top of one another. Because I'm a visual person, I kind of like to think of this as like when bricklayers make a house. And normally, and even if you're not a bricklayer, you can get this analogy, trust me, people don't put bricks just on top of one another. They actually stack them in a way whereby they kind of lie over one another, right? Because if all the bricks just lined up directly straight in a line, then anything could cause them to topple and they'd all come falling down. It's kind of the same with your investments when they're in an ETF or an individual investment. If they all sit in that very one straight line, then any little wobble can cause them all to topple. So with bricks, it's really easy to see because there's a clear end and beginning point of bricks and we therefore know where to lay them. But of course, with stock markets, things are a little bit more complex and behind the scenes and, as I say, not always necessarily explained. But there is a key measurement which helps us to see how lined up assets and stock market sectors really are, and it's known as correlation. Correlation is a figure that is given somewhere between 1 and -1. There's also a 0 in the middle if you're imagining it as like a sliding scale. Anything that is positively correlated will be given a score of 1. Anything that is negatively correlated will be given a score of -1. And then the 0 is when there is zero correlation. There is no real interaction between the movements of those assets. Of course, we don't actually live in a perfect world, so it's very, very rare that we ever see an investment that has exactly 1, -1, or 0. Rather, they're often somewhere in the middle, given a 0 point something grading, which helps us to understand how closely they move together as and when stock markets go up and down. The reason why I'm talking about this is because what most investors seek to do is to have multiple negatively correlated assets within their portfolio. Because if they're all positively correlated, if they were all that exact one, then it brings us back to my initial analogy of them all being in a dead straight line, just like the bricks, and they could all topple. Whereas, if they're all moving in slightly different ways at different times, then it helps to balance out those wobbles and keep things moving within the wider portfolio. So to help us understand this, I found some really nice coloured charts to look at exactly this correlation problem and how it kind of relates to real life. First and foremost, it's about sectors. And there are 11 specific sectors that the stock market gets grouped into. Some of the ideas you'll be familiar with, from financials to IT, sounds a bit outdated now, I know, through to energy, healthcare and utilities. And what we expect is that these stock market sectors move in slightly different ways. So you see down the middle, there is a long green stripe, and that's where they match up on the two sides of the table. And then we start to see how they interact with one another from a scale of minus 0.5 through to 1. So remember, that 1 is when they're positively correlated, i.e. they move at really similar times within the stock market and economic cycles. And when it goes through to orange and red is when they're negatively correlated. So they're moving more or less at different times. So if I zoom in on the really green patches, what we can see is that, for example, healthcare and utilities are really positively correlated. So normally when healthcare stocks are up, as are utility stocks. And actually, interestingly, if we then zoom in, what we see is that utilities and consumer discretionary, so that's products that we choose to spend on, are really negatively correlated. So normally when one's up, the other is down. And if we think about utilities and healthcare are things that we don't really have a choice about spending on them. Or rather, they don't disappear when we're in a low point of the economic cycle or the stock market cycle, because we still need to turn our lights on. Generally, it'll be the thing that will cut last. And if we need help with our health, then we've still got to go and get it done. All right, we might find ways to cut back, but normally they're still there. Whilst consumer discretionary, the nice things that we like to spend on, is the first thing that goes. And so, as a result, in tough times, they really struggle, but in good times, they really soar. So you can see there, those two sectors really clearly are negatively correlated. So if you were picking individual stocks, what you would aim to do is to have both of these areas in there, because what that would hopefully do is keep assets in your portfolio that were going up and down at different times, and therefore balance out the overall performance. For most of us, this is done automatically through the selection of broad market ETFs. If we're picking, for example, an S&P 500, a FTSE 100 or an all-world fund, then we'll already have a broad mix of those different sectors in our portfolio. And therefore thinking about them, it's not necessarily useful, it might be interesting, but it's not something that, unless you're individual stock picking or selecting more niche or thematic funds, will be something that you really need to contemplate. However, there is also asset class correlation, and I'm going to come along to another little nifty chart that I've got to show how different assets interact with each other in both good and bad times. So this table shows a broad list of different asset classes across the board, from world equities to emerging markets to real estate, government bonds, money market, which is essentially cash equivalents, gold and commodities. What we see in here is those that are positively correlated are the likes of emerging markets and world equities, aka two lots of stock markets moving more or less in a similar way. Real estate is also relatively positively correlated with stock markets, so that means that when stock markets are doing well, usually so is real estate. If we come to the redder blocks within this chart, we see that, for example, money market and gold traditionally haven't been positively correlated with world equities. We see also that government bonds have relatively low correlation when it comes to world equities, for example. So it might not be perfect, but we would expect them to still be moving in slightly different ways. This goes to explain why diversification is really key. But it's not just about putting more and more on top, but in an ideal world, you'd have more and more that were correlated in different ways. As these two charts show, we expect different assets and different sectors to move and groove through the cycles in different fashions. So what that means is that you kind of want a spread of them in your portfolio, not just a big spread of the same thing. And so I see people making this mistake with, as the example I gave at the beginning, the All World and the S&P 500 really quite frequently. It's not deliberate, it's not doing anything really wrong, it's not necessarily greatly impacting your overall portfolio, but it can put you in a position where you've just thought you were diversifying further, but actually you've caused yourself a few problems. It was actually a bloke called Peter Lynch who came up with the term Diworsification or Diversification or whatever you want to call it, how you're going to pronounce it. He related it to specifically companies, but in this case, we're relating it more to the construction of your portfolio. And having more of the same in your portfolio, as I say, it's not the end of the world, it's not a huge stress, but it can just mean that you have more fees, more admin, and more complexity than is needed. And crucially for me, what it can do is lull you into a false sense of security that you've got a really diversified portfolio that's going to do fine and protect you against risk, but actually you've got a really narrow tower of bricks. So this is not me saying that diversification is a bad thing. It's not me saying that you should have less funds or only pick an all world. This is me saying that it's actually not about fewer investments, but about smarter investments. It's about investments that fall into different categories that correlate and therefore behave across the stock market and economic cycles in different ways. So if you look at your portfolio and think that you're diversified because you've got 6 ETFs, or if you're chatting with someone at the water cooler who says that same thing, then the question really should be is how different are they really? Because diversification isn't measured by the number of stocks or funds or even assets that you own. It's measured by how differently those investments behave. So let me know in comments how you build your portfolio and if upon checking you actually see this problem of over-diversification. Do make sure that you like and subscribe as well if you're enjoying these videos, and I'll see you for the next one after a short summer break.